Hello, everyone, and welcome to today's webinar. I hope you guys can all hear me now. If you have any problems with the sound, there's a chat box on your right side where you can let us know and we'll try to figure it out. I think we'll just wait a few more seconds to make sure everyone's settled in before we go ahead and start with the webinar. Okay, I think we'll just go ahead and start. Welcome everyone to today's webinar hosted by Petro-Teach. We're very proud and pleased to hold this webinar where Dr. Babak Jafarizadeh will be talking about a very interesting topic on introduction to petroleum exploration, valuation, and decision analysis. This is an introduction to one of many courses that we offer online at Petro-Teach. We'll come a bit back to that later on and tell you guys a bit more about the online courses later. I would like to introduce today's lecturer from Petro-Teach. Dr. Babak Jafarizadeh is an assistant professor of petroleum economics in Heriot-Watt University in Edinburgh in the UK. Previously, he was a senior economic analyst in Equinor, working on oil and gas projects from all stages of the value chain and in a variety of geographic areas. He's worked predominantly on exploration of hydrocarbons and holds a PhD degree in petroleum investment and decision analysis, and also an undergraduate degree in industrial engineering. In other words, there's a lot of knowledge here. Before starting the presentation, I would like to ask you all to make sure your microphones are muted and also turn off your web cameras if anyone has that on in order to maximize the voice quality of the webinar. If you guys have any questions about the topic, please type your questions in the chat section on the right side. I will post the message on here now so that you can see where the chat box is. It should have popped up now on the right side. At the end of the webinar, Dr. Jafarizadeh will answer as many questions as possible. And I really encourage you guys to send in any questions you may have. If due to any reason you can't stay with us throughout the whole presentation, you will be able to watch a recorded video of the webinar later, which we will share on our website. I think I will leave the word to today's lecturer.
Yes, thank you, Razak, for the nice introduction. I appreciate this. And to the participants, my warm welcomes to this webinar in exploration, valuation, and decision analysis. We are today going to discuss some preliminary discussions, ideas about decision making, and we will later see how we can apply these ideas to some realistic problems in the oil and gas industry. So the topic here, exploration, valuation, and decision making, is perhaps part art and part science. We discuss decision making, and in a way, decision making is a subset of economics. So we do economics in order to show us the worth of each alternative, and then this will help us make decisions. So in a way, my worldview is that everything we do is decision making, and economics is important for any type of decision making. So today we are not going to discuss about all types of personal or corporate decisions. We are going to focus on exploration decisions. A few topics that we are going to discuss today would be first, some more in-depth discussions about what decisions are. So decisions are situations where we make a decision, and we have been making decisions all our lives. So perhaps it could be a no-brainer today that I'm going to discuss decisions. But without a formal definition of decision making, perhaps we could go astray, we could mislead ourselves. So we will have a very brief introduction to decision making, and then I will apply those discussions to the exploration value chain, to petroleum exploration decisions. And we know that most of the decisions in the petroleum exploration business are about drilling exploration wells or taking seismic information, seismic surveys, and things like that. In the end, we are also going to briefly discuss the story from drilling to market. And as Ghazal mentioned just a few minutes ago, this is an introduction, and the meat of the topics is about how we could apply these methodologies to the valuation value chain. The value chain from drilling, and even before drilling, there would be identification of prospects, then drilling, and finally, if we encounter a discovery, producing from a discovery and sending the production to the market. So all this story from beginning to end shows the value chain, which we are going to discuss in the course. And today we are going to briefly point to those aspects. So first, understanding what decisions are. And I thought we could actually start with a quote from my favorite author, Robert Heinlein, who says, "There is no such thing as luck. There's only adequate or inadequate preparation to cope with a statistical universe." And in his words, he's saying statistical universe. And I really like this. So what does he mean by statistical universe? In my language, statistical universe means uncertainty. Whenever we want to make a decision, we want to choose between alternatives that involve something about the future. And we know that future is unpredictable, or we are uncertain about the outcomes. So if we don't know about the extent of the outcomes, we are uncertain. And it's almost in all types of decisions we make. Although some decisions are more certain and some decisions are less certain or more uncertain, the uncertainty is always there. So today we are going to discuss exploration decision making, and exploration decisions, as you might have guessed so far, are one of the most uncertain decisions that oil and gas companies make. So what is a decision? The formal definition of a decision would be a choice between two or more alternatives. And it also involves irreversible allocation of resources. So in perhaps American English, we sometimes say that this is my only alternative. And this is wrong based on this definition. If we have only one alternative, it's not a decision. We cannot have only one alternative. If we are having two or more alternatives, then that's a decision situation. So that's one requirement, would have been two or more alternatives. The other requirement would have been irreversible allocation of resources. So the second requirement is a bit tricky, and perhaps we could discuss it by a simple example. Let's say that you want to buy a new car. Here you want to buy a Rolls-Royce, and you go to a dealership. So what happens there is that the dealer shows you the car, You can see the car, you can touch the steering wheel, but so far you haven't committed to this decision. At any point in time, you can go back and your situation, your financial situation would have been the same as before. You can also get the car for a test drive, and even if you test drive it, you might, in the beginning, you might say that, well, I like this car, you test drive it, you might still like that car, but the thing is that at any point in time, you can still go back to your previous situation. You can say that this car is not for me, and there are no commitments. But once you commit to buy this car, once you pay for a car and sign the contract, then it's an irreversible situation. And what I mean by irreversible is that, well, let's assume that you buy the car, you sign the contract, and you pay for the car, and 5 minutes later, you decided that, well, this is not a good car for me. I want to return it back. So you go back to the dealership and you say that, well, this car is not for me. I bought it 5 minutes ago. The answer is usually like this, that, well, you have brought a second-hand car in excellent conditions. And, well, we can buy it from you, but not the price of a new car. So by this, your situation is not reversible. You cannot go back to your previous financial situation. So that's what I mean by irreversible allocation of resources. Once you pay for a car, then it's irreversible. So that's when you have actually made a decision. So to do some practice, we could perhaps take a look at a few situations, and feel free to submit your answers in the chat section so that we could see if they are decisions or not. I'm going to show you a few situations, a few sentences that depict a situation, and if it represents a decision situation, you could say yes. If not, we could say no. And let's see how many correct answers we receive. The first example is like this. I have decided that I drink chocolate because it is soothing. So is this a decision situation or not? Well, perhaps I can give you some minutes if you like, and then I can reveal the answer. So maybe I'll go ahead with the answer. So in this situation, there is the word decide in the sentence. And we need to be careful. Sometimes in English language, we use the word decide to just represent a situation, to provide information about the situation. So this sentence, I have decided that I drink chocolate because it's soothing. I can rewrite it. I can rephrase it by saying that my idea behind drinking chocolate is that it is soothing. So it is not a situation of having 2 or more alternatives. It is not also a situation that involves irreversible allocation of resources. So this first example is not a decision. The second one, I have decided that the oil prices will go up. As you might have guessed, this is also an expression of idea. This is not a decision situation. Although the word decide appears in the sentence, it is not a decision situation. It just represents my idea of the oil markets. The third one, I have decided that the oil prices will go up, so I will invest right away. Here's my payment receipt. So in this example, we have 2 or more alternatives. So the first requirement for a decision has been fulfilled. I could go away or I could invest. So 2 or more alternatives is there. Is this an irreversible decision? yes, it is an irreversible allocation of resources, because once you pay for the investment, you cannot easily go back to your previous situation. I believe we have one more. I am going to diet, so I avoid fatty meals. This is a bit tricky, and the answer is that yes, this is a decision situation. Why? The first requirement is that two or more alternatives. So you could diet or you could not diet. Well, there are two alternatives. Does this involve irreversible allocation of resources? I would say yes, because once you decide to diet, well, you have to spend your money and your time on eating healthy food. So the opportunity is lost. You cannot go back, for example, to yesterday and have a tasty steak. For this, we are dealing with a situation that has irreversible allocation of resources. So the last example is, of course, a decision situation. So these were examples from real life. Perhaps we could apply our ideas to a problem in the oil and gas industry. So here we are talking about drilling and exploration well. And to make it very simple, we can say that there are only going to be two outcomes out of drilling and exploration well. There's going to be oil or dry. And you know that in reality, there are a multitude of outcomes. Oil itself could be a variety of different outcomes. It could be one drop of oil discovery or a large discovery. But for now, just to make everything simple, we have simplified this decision. We drill a well, the outcome could be oil or dry. If it's dry, that means that the exploration well has been unsuccessful and we pay for the drilling cost. If it's oil, there's a reward. So you might ask, what's the reward for discovering oil? The problem is designed like this. If we find oil, the worth of the exploration would have been $130 million, and the cost of drilling would have been $30 million. So a discovery would give us a net payoff of $100 million. So we could basically summarize the situation by saying that the outcome of oil has $100 million net reward. The outcome of dry has $30 million negative reward, or cost of $30 million. Well, right now, the problem is simple. I can make it a bit more complex by saying that a third-party company is approaching you and they say that they can buy the drilling rights from us for $10 million. They will drill the exploration prospect themselves. If they find oil, they will give us another $10 million. So now we are facing a decision situation, which is summarized here in this table. In this decision situation, we have two alternatives: to drill or to sell. If we drill, there would be two outcomes, of course. It would be oil outcome or a dry outcome. If we discover oil, the net outcome would be $100 million, which here I'm just writing $100. If we encounter a dry hole, the outcome would be minus $30 million, which here again I'm writing as minus $30. If we sell, then in case of oil, we'll receive an original $10 million plus another $10 million of bonus. If the outcome of the well is dry, we will still keep our original $10 million. So here's the summary of the situation. My question right now is that, do we have enough information to make a decision? Well, most people say that we don't have enough information. Of course, we have information about the outcomes and about the decision alternatives that we have. And in the exploration business, there's never enough information. You always could use more information in refining your uncertainties and improving your decision making. But we are not in the luxury of asking for a lot of information. The question here is that if you are able to ask for one piece of information, what would that be? Most people ask for a likelihood or a probability for success. So the answer to this question, do we have enough information to make a decision, is generally no. And one additional piece of information here to help you make a decision would have been that I can give you the chance of success in this prospect. The probability of finding oil here is 0.4 or 40%. It just means that our geologists, our engineers, they have looked into a large amount of data and they have identified patterns within the data and they have come up with the chance of 40%. So now that we know 40% is the chance of finding oil, should we drill or should we sell? We can still summarize the data in this problem in this table. We could drill, the outcome is 100 if we find oil, or minus 30 if we encounter a dry hole. We could sell, the outcome would be $20 if we find oil, or $10 million if we encounter a dry hole. The probability for oil is 40%, and it applies to both alternatives. The probability for dry hole is 1 minus 40%, because we originally assumed that there are only two alternatives and there are only two outcomes for each alternative. So if the outcome of oil has 40% chance, the outcome of dry has 60% chance. The total probability should add up to 1. So with this information, now we can make a decision. We could say that we decide based on expected values. The higher the expected value, the better the alternative. So formally, we could say this. We could say that we have sell and drill alternatives, and the expected value for selling alternative would have been multiplying the probability of success at the reward of success plus the probability of failure times the cost of failure, which would be like this. So 40% for the sell alternative, that would be 40% times $20 plus 60% times $10. In total, sort of an average, it would be $14 million. The expected value of selling. The expected value of drilling would have been 40% times $100 million plus 60% times minus $30 million. This would translate into an average number, or an expected number, which is $22 million. So now we can make a decision. We decide based on the alternative that has the highest expected value. And in this case, the drilling alternative has the higher expected value. So to make good economic decisions, we drill. Now, a point of caution. We make decision based on drilling, and we will never realize $22 million. This $22 million is an expected value. And contrary to its name, we should never expect the expected. The expected value is just a measure for decision making. It will never happen in reality. In reality, we drill the well, it could be either $100 million reward or minus $30 million cost. It could never be $22 million. $22 million is just a decision measure, which we are using in situations where we have uncertain outcomes. So this was a simple example. And in the oil and gas business, we can usually use back of envelope calculations to come up with the right answers. Formally, in the oil and gas business, we use an analytical model called the decision trees. And perhaps I can show you the decision tree for this problem. A decision tree for this problem would have been starting with a decision node, which here I'm showing with a green square, and there are two branches coming out of the square showing the drill and sell alternatives. So the branches coming out of the decision node would have been the alternatives. If I sell or if I drill, then there would be uncertainty. I represent uncertainties with a circle node. So the red circle here represents an uncertain situation. So for both drilling and selling alternatives, I have an uncertain situation with two branches coming out of the uncertain situation. They represent the outcomes. So the outcome of oil has 40% chance. The probability for this outcome is written just below this branch. And the outcome of dry is 60%. Here I'm just writing it close to the branch. For the sell alternatives, we had the same outcomes and identical probability. So 40% for oil and 60% for dry. The outcomes are, however, different. For drilling, the outcome, which is here at this endpoint, written in front of this triangle, is the outcome for this branch. It just means that if we drill and encounter oil, the reward would have been $100 million. If we drill and the outcome is dry, then the reward would be minus $30 million. So this is a decision tree representation of the problem that we just solved. In the oil and gas business, the decision trees are heavily used, and they are some of the common analytical measures that managers are comfortable using them, and analysts spend a lot of time modeling exploration problems using decision trees. In this decision tree, I can summarize the result by replacing the uncertain nodes with the expected values that we calculated earlier. So an alternative or equivalent decision tree here would have been to make a decision. There would be two outcomes, drill or sell. If we drill, the expected value, which I'm writing here, would have been $22 million. If we sell, the expected value would have been $14 million. So now, to solve this simplified decision tree, it's very simple again. We decide based on higher expected value, which would have been drilling in this situation. So we could move on, and in the remaining time, I can also tell you about another valuation measure, another pitfall that we discuss. So perhaps you have heard of Flaw of the Averages. The concept has been popularized by a book of the same name by Sam Savage. And the story behind Flaw of the Averages is that there was once a person that wanted to cross a river with an average depth of 3 feet, but he was drowned because averages, they just show an average number. They do not show the variability. So an average depth of 3 feet just means that there are some places in the river that are shallower than 3 feet, and there are some places that are deeper than 3 feet. So in general, an average number is not a representative of a population. You might say that, well, this is a no-brainer. It is very obvious. In the oil and gas business, because of the other complexities, we sometimes encounter this flaw of the averages. Here's an example. We are drilling a well with 30% chance of success and $15 million cost. It could lead to an average discovery of $30 million. So I can draw a decision tree for this problem. My first decision would have been to drill or walk away. If I walk away, the outcome would have been 0, shown here in this end node. The triangle shows the end node. If I drill, then I face an uncertain situation. It would have been a circle node with branches showing the outcomes. So 30% chance of success, it just means that 70% chance of dry hole. And because the cost of drilling is $15 million, if I encounter a dry hole, then I will have to pay the cost of $15 million. So my financial situation would have been minus $15 million. If I find oil, then there's a decision to develop the field or walk away. If I walk away, well, again, I will have to pay $15 million the cost of drilling. But if I develop, here it says that the average discovery is worth $30 million. So my outcome would have been $30 million. So if I solve this decision tree, it would have shown that the expected value of drilling would have been minus $2 million. And the expected value of walking away is, of course, 0. So I choose the maximum between 0 and minus 2. The value maximizing decision would have been to walk away. Or in other words, not drilling is the best course of action in here. But then you might say that this discovery was an average number. It represents an average of a population. So the reservoir engineers here would have said that, well, this $30 million represents an average thickness of the reservoir. But that average thickness comes from a simulation model that has many extreme numbers, many extreme realizations. In reality, it's just an average of perhaps a low thickness and a high thickness. Here we are encountering a sort of a flaw of averages. If we make a decision and plan based on average reservoir thickness, then the reward would have been $30 million, or the net worth, the NPV of the project would have been $30 million. But in reality, it could be either a low thickness or a high thickness. In case of the high thickness, we encounter a large amount of oil in place, and we have other plans for that. If we were deciding to develop the average field using an FPSO, now that we know that there are a large number in case of a large discovery, perhaps we could use a standalone development that has economy of scale. So we just want to see here, if we encounter a discovery, instead of one average number, perhaps by considering 2 representative cases, will it lead to other decisions? And the answer is here. So the original decision tree, which we discussed, is here in the above. And now we want to consider the case that we encounter 2 different discoveries. So again, the decision would have been to drill or walk away. There's an uncertainty of finding oil or dry, and development. Now, the decision to develop would encounter another uncertainty, the uncertainty about the size of the discovery. It could be a large discovery with 20% chance based on our understanding of the reservoir or understanding of the oil in place. And it could be, with 80% chance, it could be a small discovery, which would say that with a small discovery, we use cheap or low-cost production facilities when we could still make a positive NPV project. So now we introduce some non-linearities into our model. For a small discovery, we use low-cost equipment. For a large discovery, we use economy of scale. Now, with this level of distinction, do we make the same decisions? So here I have calculated the expected values for each decision. And as you can see, now that we have higher granularity of our economic situation, we make a different decision. Just remember that I didn't create value here. I'm just looking at a problem with a better lens, with higher resolution. Now that I have higher resolution, it turns out that the drilling alternative has a higher expected value. So this was an example of falling into this flaw of the averages trap. It doesn't involve crossing a river and all those simple explanations. It just shows that by changing the granularity or the resolution, you could end up with different decisions. So finally, in the remaining minutes, perhaps we could discuss the value chain in the exploration and very briefly discuss the value chain. So exploration decisions are uncertain gambles. We spend a large amount of money into drilling a well, and most exploration wells have turned out to be dry holes. If you look at historical performance of exploration wells, most of them have been dry holes. So it's a large gamble, a gamble of multi-million-dollar investments. And we usually, to analyze these types of gambles, the simplest form of a decision tree would have been like this: a decision to drill or drop or walk away. Walking away has $0 consequences, but drilling is an uncertain situation. We have the chance of success. And because we consider here simply that there are only two outcomes, we would say that the chance of success is for oil and 1 minus chance of success is for a dry hole. If we encounter a dry hole, we pay the drilling cost. If we find oil, we get the reward, which is the net present value of whatever happens later on. You might ask, what is that? Where do we get this reward? And the answer is that simply, if we make a discovery, then perhaps we could show the financial transactions later on. Here we have 2 dimensions. The vertical axis shows the amount of money that we are going to pay or receive, and the horizontal axis shows the time dimension. So this point would be right now, right after the discovery. If we make a discovery, then we still need to pay other costs. We need to pay appraisal costs, development costs. These are all negative. So for a period of time after the discovery, we still encounter negative cash flows. Then, after a period of construction and preparation and development, we have a production. Our production starts, goes to a peak, and then declines. We sell the production in the market, and we get production revenues. In order to operate our assets, we also pay operating costs, we pay taxes to the government, also pay variable operating costs like electricity or labor. These are variable and they move along the level of production. So now we have almost all the elements of a cash flow profile. We net off these cash flows in every year, discount them to present time, and we get the reward. So in a way, I told you this story from after discovery to abandonment of the assets. It's a long story, but in order to assess the value, I just told the story up front. So in this course, in exploration valuation, we usually discuss all the levels, all the steps that go into this cash flow. How do we estimate the cost? How do we estimate the production? Where do the revenues come from? Where do the costs come from? So our decisions should be based on value. One alternative measure would have been volume. So I have heard it in the old days that discoveries, the good discoveries are those that discover a large amount of oil or gas, and the bad discoveries are those that are small. And that is generally true, but it depends on many other assumptions. For one, it just means that the discovery needs to be valuable enough to pay for the cost. Another thing is that the way we produce is also important. Here's an example. We encounter a discovery, or let's in a thought experiment, we have two discoveries of the same size and the same amount of original oil in place. Again, same level of recovery factor, but we produce the oil in two different regimes. The one in the left is a normal production. The one in the right is what I call the accelerated production. So the area under the curve is the expected ultimate recovery. From the economic point of view, these two are very different. From the volume point of view, they're equal. They represent equal recoveries. But from the economic point of view, these are very different. The one on the right-hand side is called the accelerated production, produces higher economic value. Why? Because of something we call time value of money, which we discuss in the course. So what is the goal of any corporation? Just briefly, here is Tesco's annual report. And in a part within that report, they're saying that everything we are doing reflects my determination to deliver shareholder value. I looked also into an oil company like BP. In BP's 2019 annual report, you encounter similar discussions, creating value, and then they discuss that we develop the resources that meet our return threshold. So what do they talk about? We talk about value. We talk about responsibility to shareholders. So what is a shareholder value? It's basically about making money grow. So if your discoveries, if your projects make shareholders' money grow, then they are good. If not, they're not going to be good. So it appears that the making money grow objective could be also explained by increasing firm size or increasing stock prices. But in general, they're almost the same. So in economic decision analysis, which is the subject of this webinar and the course that ensues, basically we are talking about translating the risk and translating money, translating the engineering disciplines into money terms. So we estimate the project risks, we have a view of project cash flows, and based on this information, we come up with a relative ranking of the projects, and finally, we assess the effect of the projects on a company's position. So in general, we accept those projects that their benefits outweigh the cost. If this happens, then this is an acceptable project. In reality, the devil is in the details. So we have uncertainty, we have different currencies, for example, our cash flows happen in different points in time. So there's a lot of comparison between benefits and costs. For uncertain situation, we could refine this. We could say that expected benefits should outweigh the expected costs. If this happens, then we are creating value. So perhaps we could take a look at the value chain, a very simplified value chain for oil starts with exploration, then production. The produced oil and gas, or produced oil, of course, needs to be transported to refineries. So this is a value chain in a nutshell. In the gas industry, is almost similar, except that the downstream part of gas would have been about processing, transportation, and finally marketing and optimization that ensues. The gas business, the natural gas business, is a bit different, mainly because the downstream, the midstream and downstream portions are different. But this will have a dire effect on the economics of gas projects. So considering the whole value chain, we should come up with the cash flow profile for each project, each outcome of a project, and calculate the results. The dilemma here is that when we need the information to make decisions, there are only a few pieces of information available. So as we manage and operate our assets, we get more information, but by the end of the asset's life, we don't need that much information because all the decisions, all the major decisions are in the early phases of an asset life. I can show it like this. The horizontal axis is the phases of a project. The vertical axis is the usefulness or availability of information. In the exploration phase, you need a lot of information. Every bit of information is going to change your decisions, but there are not many pieces of information available. As you manage your project, more data is available, but because your designs are solidified, your decisions have been made, the major decisions are already in the past, the usefulness of the data declines here as the dynamics here. So this is a dilemma in oil and gas business and mostly in other uncertain businesses. So in order to understand better, we basically discuss the value chain as we discuss. The value chain for any project would have been starting from creation or identification of an opportunity. Then if an opportunity looks promising, we do some feasibility studies. Further on, we could do formal analysis, do the planning, and finally do the execution. For oil and gas projects, it's going to be almost the same. So in the early phases, the idea comes from geology and geophysics discipline. They come up with traps, identify traps of hydrocarbons, and they assign, based on their geological models, they assign a chance of success. So here I call it PG, probability of geological success. They also come up with some idea or estimates of in-place volume. Then the other level would have been for reservoir engineers to come up with production profiles and recovery factors, that by saying that if you make a discovery, then these would be the production profiles. These would be the recovery factors based on the information that we have. Well, in order to enable that production, the drilling and well design discipline needs to come up with the well plans and their cost. And the facilities and infrastructure design need to come up with a development solution, how we drill the well, where do we process them, where do we process the production, how do we export it, and all these questions need to be answered. Finally, the economic decision analysis will get all this information and will combine them into an economic measure. So in a way, economic decision analysis is like an integrated platform. It integrates all the other disciplines into a measure of decision making. So I hope this webinar was informative to you. If you are interested, perhaps you could also attend the longer course, which will happen in during the September. and we will discuss the details that we discussed here in more detail. With this, back to you, Raza. Perhaps you could discuss the details of the course. In the meantime, the participants, could you please think of any questions? So there, in the last remaining 10 minutes that we have from this to the end of this webinar, I would be happy to answer any of your questions. So back to you, Raza.
Big thank you to the lecturer, Dr. Jafarizadeh, and thank you all for your attention during the presentation. As mentioned, this course will also, a longer version of this course is offered by us. And therefore, I would like to take the opportunity to let you know about this. The course is about exploration, evaluation, and decision analysis, as we've heard a bit about in today's webinar. The online course goes further in depth on the topics that have been discussed today. In addition, it also offers practical exercises in order to reinforce learning. The entire course will be run online and expands over 4 sessions, which last approximately 3 hours each. This means that you can complete the online course from the comfort of your own home. And the dates are, as mentioned, 21st to 25th of September this year. We've also opened for early registrations, which are discounted. If you'd like to know more about this course, please visit our website, which is Petro-Teach.com, or send us an email for the course brochure, which we can send you as an attachment. So we've received a question from the audience of the webinar. I will read up the question now, and Dr. Jafarizadeh will answer it. So someone is wondering, how do the oil prices affect the upstream oil industry?
Yes, thank you, Razal. That's a very good question. So for the cash flows that we discussed here, they are having different elements. So one element of the cash flow would have been the cost, the other, which is negative sign. The positive sign in the cash flow would have been coming from the revenues. And in the oil and gas industry, the revenue is basically the most part of the revenue, the largest part of the revenue would have been to sell the production. We produce oil or gas or condensate, and we sell this production in the market to get our revenues. There are also other portions of the revenue, like perhaps tariffs. If we let other companies use our infrastructure, like our pipelines, then we could gather tariffs. But most of our revenue comes from selling hydrocarbons in the market. And as you mentioned, oil prices, they change all the time, and with them, our revenue also changes. So what is the effect of changing oil prices on our valuation? It has a very deep impact on our valuations. So one source of uncertainty would have been the future oil prices. Of course, another source of uncertainty is about the subsurface. So if I want to list the most important key uncertainties that we need to consider in any exploration project, would have been the subsurface uncertainty, if there is oil or not, and how much the oil in place would be. The second one would have been the public uncertainty or the market uncertainty, which will affect almost all projects, but it has, to some extent, some projects are more exposed to oil prices, some projects are less exposed. So oil prices, they change, and we recently encountered some very wide fluctuations in the oil market a few weeks ago, we experienced a negative oil price. Of course, it was the American markets, the NYMEX, West Texas Intermediate and NYMEX. But it doesn't remove the necessity to include the uncertainty of oil prices in our analysis. Within this course, we are also going to discuss the details of how we could include oil price uncertainty within our valuation models. The key takeaway about oil price uncertainty is that, yes, oil prices are uncertain, but our models should basically represent the observations that we have in the market. They should be consistent with the ideas and economic arguments within the market. So yes, just to give you a short answer, I know that it was long, but the short answer to this big problem is that there are models to consider the uncertainty in oil prices, and we are going to discuss some of the basic models here in this course. If you have any other questions, I'll be happy to answer them.
Thank you, Dr. Jafarizadeh. There is coming another question for you. Someone is wondering, what is your forecast for the oil prices in 2020 and the coming years, if you have any comments about that?
Good question. One thing I learned in the oil and gas business is that we should refrain from forecasting because all forecasts turn out to be wrong. There have been departments owned by governments that have actually done the forecast and they have ended up being wrong all the time. So no forecast has survived the test of time. So for this reason, we basically do not do any forecasts in valuations, but we perhaps could consider the behavior of oil prices, the uncertainties of the oil prices in our valuation. So these are two different things. A forecast means that by saying that, well, next year's oil price would have been $40 or $50. This could be right or wrong, and I assign a very high probability that it would be wrong. But by saying that, by describing the uncertainty like oil prices would have been between perhaps $20 to $80 per barrel, and that would be an estimate. That would be an uncertainty presentation of something that is actually uncertain. I would go one step further, and by saying that, well, the oil prices would have been between 20 or to 80, for example, with 80% confidence. So I have added one level of uncertainty. I have added one level of statistical representation of my uncertainty representations. So in valuations, we acknowledge that there are uncertainties. We acknowledge that some of the items, some of the factors within the valuation model are uncertain and unpredictable. But it doesn't stop us from making decisions. We have to make decisions based on the uncertain factors. The best we can do would be that we come up with estimates and presentations that actually agree with the reality and they agree with the economic theories or engineering theories. So that's the best we can do. And that's why I said that, well, exploration decisions and decision-making on the uncertainty overall is part art and part science. We have good decision makers and bad decision makers. And the good decision makers are sort of those that know about the decision situation, and they also possess this art of making good decisions. So I hope this was a bit informative. In short, I refrain from making predictions. Is there any other questions? I'll be happy to answer.
Thank you so much, Dr. Jafarizadeh, for your time on this interesting presentation and also for answering the questions after the presentation. I would like to thank you all for your participation in this webinar hosted by Petro-Teach. We are coming to the end of the webinar. I hope the audience enjoyed it, and please do not hesitate to contact us for information about our online courses or further webinars in the future. You can always send us an email at train@petro-teach.com or visit our website for more information on the online courses and also where to find us on social media. So this concludes today's webinar. I hope you all enjoyed it. Have a great evening, and you may now disconnect. Bye-bye.